The opening range breakout, or ORB, is a staple strategy among professional traders, allowing them to capitalize on early session volatility and institutional order flow. It's particularly effective in stocks and futures since the first few minutes of a session can often set the tone for the day. At its core, the ORB strategy defines a price range in the early minutes of a session and then trades in the direction of a breakout. The logic is simple. If price escapes the initial range, it often signals continued momentum. While some traders scalp quick moves, others hold for longer trends, making ORB one of the most versatile trading strategies available. But successful ORB trading requires more than just reacting to breakouts. It demands an understanding of market conditions, volatility, and risk management. In this guide, we'll cover everything from entry models to stop-loss strategies and take-profit techniques, ensuring you can apply ORB successfully across different markets. The opening range is defined by identifying the high and low of price action during a specific time window after the market opens. Once this range is set, traders look to enter in the direction of the breakout. This structured approach helps traders avoid guesswork, providing clear rules for when to enter, exit, and how to manage risk. While different traders use different ORB timeframes, the most common timeframes tend to put you into one of two categories. The 5-minute ORB and the 15-minute ORB are best for aggressive traders who want to be in and out of their trades quickly. Conversely, the 30-minute ORB or the 1-hour ORB is ideal for traders looking for strong trend confirmation, which reduces the likelihood of false breakouts. A wide ORB range suggests high volatility, while a narrow range indicates consolidation. The right time frame depends on both the trader's style and the asset's behavior. Once the opening range is established, knowing which direction to trade becomes significantly easier. Traders look for price to break either above or below the range, signaling a potential trade setup. If price breaks above the opening range, traders enter a long position expecting bullish continuation. If price breaks below the opening range low, traders enter a short position anticipating further downside. ORB works because breakouts from early session ranges often signal strong institutional participation, leading to sustained movement. However, not all breakouts are valid. False breakouts occur when price briefly escapes the range, only to reverse back inside. The key is filtering out low-quality trades by using the right entry model and confirmation techniques. Before committing to an ORB trade, consider the following confluences. First, volume confirmation. Breakouts with strong volume are more likely to sustain momentum. Next, consider the overall market trend. ORB trades work best when allied with the broader context of the entire market. Also consider economic news and events like CPI reports or the non-farm payroll numbers. Fed meetings and earnings releases can also influence breakout. You could also consider any pre-market movement. If a stock gaps significantly overnight, part of the move may already be priced in. Executing an ORB trade effectively requires more than just jumping in the moment price crosses the range. A successful trade depends on how price breaks out, how the market responds to the breakout, and whether or not there's even follow-through momentum. There are multiple ways to enter based on the strength and confirmation of the breakout. Choosing the right entry model is key to filtering out weak moves and optimizing trade execution. First up is the breakout entry, and it's the most aggressive approach. It involves entering a trade the moment price breaks outside of the opening range. This method is designed to capitalize on immediate momentum and is best suited for markets where price tends to continue in a single direction after the open. Traders who use this approach expect that the breakout is strong enough to sustain its momentum without needing a pullback or confirmation. This method is most effective in instruments with high volume and institutional participation, such as major stock indices or forex pairs during key session openings. The biggest pro for using the breakout entry model is the fast execution. You enter as soon as the breakout occurs, ensuring that you don't miss any explosive moves. Another is that you capture the strong momentum. It works well when price moves decisively with volume behind it. The major con, however, is that you're at a high risk for false breakouts. If the breakout lacks momentum, price can reverse quickly. This entry type works best for traders who are comfortable with fast execution and a good knowledge of how to use stop orders. The retest entry is a more patient approach that provides additional confirmation. Instead of entering immediately when price breaks the opening range, the trader waits for price to return and test the breakout level before entering. The logic behind this method is simple. If the breakout level holds, it confirms the breakout's validity and potentially provides a lower risk entry. This method is particularly useful in markets that tend to retest breakout levels before continuing in the breakout direction. The biggest pro with the retest entry is that it filters out weak and false breakouts and gives time for other confluences to form. On the other hand, the single biggest con is that it can just flat out miss strong breakouts. If price never returns to retest, you just won't get an entry. Traders who use this method often look for a high probability setup where the retest is clean and supported by price action confirmation. This is effective for those who prefer a more structured and generally lower risk approach. Remember though, these are just entry models. You can't ignore confluences. Let's shift from entries to stop losses. Like with any position, your stop loss needs to protect your capital without being too tight. Otherwise, you risk getting stopped out by normal price fluctuations only to see price move in your direction afterward. So here's some suggestions. If you're new to ORB or just have a lower risk tolerance, I'd recommend placing your stop loss on the other side of the range from your entry. That's below the opening range low for longs or above the opening range high for shorts. This is the most conservative stop loss placement and one of the most commonly used because it ensures that your trade remains valid as long as price never full-blown reverses. By placing the stop on the opposite side of the range, you're giving price plenty of room to accumulate orders before continuing in the direction of the breakout. Keep in mind that because this method requires using the entire opening range as the stop distance, it can result in a larger stop loss. This means that you need to ensure that the risk to reward situation aligns with the trade. I really like utilizing some form of the ORB range as my stop loss since the size of the range changes based on market structure and volatility. It kind of creates a faux ATR scenario for your stop loss without having to actually use another indicator. A more aggressive approach is to place the stop loss at half the length of the opening range. This method still allows some room for price to develop, but could offer better risk to reward scenarios depending on your style and asset. If you're not exactly sure what I mean when I say half of the opening range, here's an example. If the opening range is 40 points, you'd place your stop loss 20 points from the breakout level. This approach is particularly useful when the market has shown strong momentum, reducing the likelihood of a deep retest. However, because the stop is placed much closer to the breakout level, there is a chance of getting stopped out by normal price movement. This method works well in high volatility and fast-moving markets, but traders should ensure that their entry aligns with a strong confirmation of the breakout to avoid unnecessary stop-outs. Another structured approach is using a fixed number of pips or points for the stop loss. Instead of basing the stop on the ORB range itself, you can set a predetermined stop loss distance that aligns with the typical price movements of that asset. This method could be effective when you've backtested different stop loss sizes and found an optimal level, or when the asset being traded has consistent price movement tendencies. Keep in mind, though, that because this method does not adjust for volatility, it can result in stops being too tight or too wide depending on that day's market conditions. Traders should backtest different fixed stop levels to determine what works best for their chosen instrument. The last method is using a recent swing high or low as the stop level. This is a more discretionary approach that works best for traders using retest style entries or those trading higher ORB timeframes such as the 30-minute or 1-hour opening ranges. For a long trade, the stop loss is placed below the most recent swing low before the breakout, and conversely, for a short trade, the stop loss is placed above the most recent swing high before the breakout. This method allows for natural price movement as it aligns with key price levels where buyers or sellers previously stepped in. It's particularly effective when trading higher timeframes where swings are more defined, or when using that retest entry like we discussed where price revisits a key level before continuing. The downside of this method is that swing points can be subjective. Different traders may identify different levels, making it a less mechanical stop loss method. Additionally, if the stop loss is too far from the entry, the stop loss can become excessively wide, making risk management more difficult. Backtesting and experience are key for traders who want to use this method effectively. Whichever method you choose, the key is to remain consistent. Backtest different approaches and refine the stop loss strategy to fit your personal risk tolerance and the market conditions. Now that we've got the entries and the stop losses out of the way, let's talk about taking profits. A structured take profit strategy is just as important as the entry or stop loss. Without a clear exit plan, you can either leave profits on the table or hold on to trades way too long, risking reversals. The key is to choose a take profit method that matches the volatility and the price behavior of the asset being traded. Here's 3 different ways to take profits for you to take into your backtesting. One of the simplest and most effective ways to determine take profit levels is by using multiples of the opening range itself. Since the ORB range represents a period of price discovery, its size naturally adjusts to the day's volatility. By using multiples of this range, traders can create a dynamic take profit strategy that adapts to different market conditions. For example, you could consider taking profits at half of the opening range for a conservative profit in a slower moving market, or you could target 1 times the opening range, which would fall in line with the idea of a measured move. Honestly, you could even target 2 times the opening range or sometimes even more in high momentum conditions. Like I mentioned with the stop losses, utilizing the orb range in your exit plan can be really beneficial to make sure you're capturing expected movements on your winners, similar to how an ATR setup would. Another structured approach is to set a fixed risk to reward ratio or a specific pip or point distance based on the asset's typical price movements. Some traders prefer risk to reward ratios like 1-to-1 or 1-to-2, ensuring that each trade is planned with a clear reward expectation. Others set a fixed take profit level, for example 20, 30, or 50 pips, depending on the volatility of the instrument they trade. This method works best when you backtest different take profit levels to see what aligns with historical price action and average breakout extensions. A 1-to-2 risk to reward may work well in Forex, but for a highly volatile index, a fixed 50-point target may be more appropriate. Since every asset behaves differently, testing multiple risk to reward structures is key to refining this approach. An advanced way to set take profits is to target nearby liquidity zones where large orders are likely to be triggered. Try using some of these levels when backtesting. Look for previous days' highs and lows. Price frequently tests these areas, making them ideal take profit targets. Also look for swing highs and lows. If a breakout aligns with a previous swing target, targeting that level ensures profits are taken before a potential reversal. Also look for round numbers or psychological levels. Markets tend to gravitate towards big whole numbers like 4,000 on the S&P 500. Lastly, look for gaps. Price loves to revisit gaps, and if your direction is in line with a gap that hasn't been addressed since it formed, it could be a good place to take profits. The best approach depends on the asset being traded, the trader's risk tolerance, and market conditions. The key is to backtest, refine, and remain consistent. Let's talk a little bit about how to approach different asset classes with ORB, because not all assets respond equally to the same ORB timeframes. The New York Stock Exchange opens at 9:30 a.m. New York local time. Traders using ORB for stocks and indices will place their range at this open and often find that the first 5 or 15 minutes work well due to the high volatility at the open. The New York Forex session opens at 8 a.m. New York local time, meaning a trader using ORB on Euro USD or British Pound Dollar may find better results using an ORB from 8 to 8:15 a.m. rather than waiting for the stock market open. If trading Aussie dollar or Japanese yen-based pairs, consider using the Tokyo session ORB instead of the New York Forex session or the New York Stock Exchange open. Ultimately, the best way to determine your ideal ORB timeframe is through testing and data collection. Every asset behaves differently, and even the same asset may perform better with different ORB settings depending on market conditions. To refine your ORB strategy, you should backtest multiple ORB timeframes on your chosen asset to identify patterns. You also need to be tracking your win rate and expectancy. And always make sure to adjust based on volatility and market conditions. Some days may call for a shorter ORB while others favor a longer one. Instead of forcing a generic ORB timeframe, let your trading style, availability, and asset behavior guide you to the right choice. ORB success isn't about using the same settings as everyone else. It's all about finding your specific edge. If you're new to ORB, start by backtesting different session start times, entry models, and stop loss approaches. The more data you collect, the more confidence you'll have in executing your trades. ORB is a structured approach to trading momentum, but it's not a one-size-fits-all system. Developing an edge means refining your strategy to fit your personality, risk tolerance, and market conditions. Test, refine, and commit to a consistent process. That's how professional traders turn ORB from a strategy into a repeatable, profitable system.